Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. The JP Morgan Equity Premium Income ETF, also known as JEPI, is a very popular dividend income ETF among investors. In recent months, owners of JEPI face an unpleasant reality. The monthly dividend income generated by JEPI keeps getting smaller and smaller. In April, JEPI paid dividends of 44 cents per share. In May, the dividend became 42 cents. In June, it got reduced to 36 cents. July 39 cents, and finally in August, dividend dwindled below 30 cents per share. Many JEPI investors are wondering, is this trend going to continue? Or more importantly, is JEPI still a good option for dividend generation? In today's video, we are going to dive into the details of JEPI and break down the nitty-gritty of this ETF. We will unveil the reason behind the decrease in dividend and provide our suggestions. So stay tuned. And if you like what you see here, hit the like button below and subscribe to our channel. As we discussed in a prior video, JEPI employs not one, not two, but three investment strategies that make it stand out from the crowd. We've got the equity income strategy, which focuses on dividend-paying stocks. Then there's the capital appreciation strategy, aimed at long-term growth by investing in high-quality stocks with attractive valuations. But here's where it gets interesting. JEPI also uses covered call options strategy to generate additional income. From the ETF's fact sheet, JEPI generates income through a combination of selling options and investing in U.S. large-cap stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. This strategy, together with the fund's construction process, enables JEPI to deliver a significant portion of the returns associated with the S&P 500 index with less volatility, in addition to monthly income. As of 6/30, JEPI delivered a 12-month rolling dividend yield of 11.04%. However, their most recent 30-day SEC yield falls quite a bit to around 7.7%. What is driving the lower dividend yield we have witnessed in recent months? To answer that question, we need to first refresh our memory on how a covered call works. Covered calls allow investors who own shares of a company to sell call options on those shares. Doing so will provide investors a premium, which is just a fancy way of saying payment. It's like getting paid for letting others potentially buy your shares at a specific price in the future. This strategy is often used by investors who have a neutral to slightly bullish outlook on the asset. If the stock price remains below the strike price when the option expires, investors who sell the option basically pockets the payment while still owning the underlying stock. In other words, a covered call allows investors to earn income while still holding onto the shares. The drawback of covered call is that it can limit capital appreciation to some extent. You see in the chart that as the underlying stock prices keep rising, the payoff is limited, or capped at the strike price. All in all, a covered call allows investors to receive premiums upfront while still enjoying some limited upside price appreciation. In 2023, the stock market witnessed strong rallies as inflation appears to be under control and the overall economy looks better than expected. S&P 500 is up around 18% from January to July. Since covered call strategy is selling out of money options, if the market has large up moves, sellers of covered calls will miss out the upside potential beyond the strike price, meaning less income generated for the fund. Consequently, when the equity rallies, it is typically associated with lower volatility in the market, as represented by the VIX. You can see that VIX started the year around 23, it increased above 25 with the SVB collapse in March, and has been on a steady decline since. By the end of July, the VIX level fell below 15. When VIX is on the higher side, those option contracts can be more expensive to buy. Since JEPI is selling options, when VIX is high, JEPI is cashing in on those expensive option premiums. On the other hand, in a lower volatility environment, option prices will become cheaper, and JEPI will receive less in terms of option premium. So we think JEPI's lowering dividends are mainly due to the equity rally, combined with lower VIX levels we have seen in 2023. Now, where does this leave us, the savvy JEPI investors? Well, I am holding on to my JEPI positions. But at the same time, I've been allocating capitals into JEPQ. JEPQ is JEPI's brother or sister, but instead of focusing on S&P 500 index as its underlying assets, JEPQ holds a majority of tech companies, as it applies the same cover call strategy on NASDAQ 100 index. JEPQ has been riding the bullish tech wave like a pro. Compared to JEPI's 30-day SEC yield of just 7.7%, JEPQ is still able to deliver 10.46% 30-day yield. On top of that, JEPQ returns more than 18% year-to-date, compared to JEPI's 1.93%. Now let's take a detour back to the JP Morgan website and understand more about the wonders of JEPQ. From JEP's fact sheet, the ETF aims to generate income through a combination of selling options and investing in the U.S. large-cap growth stocks, seeking to deliver a monthly income stream from associated options premiums and stock dividend. The ETF seeks to deliver a significant portion of the returns associated with the Nasdaq 100 index with less volatility by constructing a long equity portfolio through a proprietary data science-driven investment approach in order to maximize risk-adjusted expected returns. What it means is that JEPQ utilizes the same strategy as JEPI, but it focuses on equities in the Nasdaq 100 index. While tech stocks historically had a higher beta, or volatility, than the broader market, JEPQ is able to select individual tech stocks with better valuation and hence lower volatility. This is demonstrated in the portfolio comparison between JEPQ and the Nasdaq 100 index. JEPQ has a much lower standard deviation of 18.78 versus the benchmark's 25.96. At the same time, EPS growth for JEPQ is higher at 12.57 compared to the benchmark's 11.87. I need to point out that while JEPQ is currently enjoying the ride of the tech wave, if the tech sector takes a nosedive, JEPQ will also be negatively impacted. That being said, if the market does decline from here, it will probably mean the VIX index will increase in value. This, in turn, would imply that option premiums will go up. Covered call ETF like JEPI and JEPQ will then be able to distribute larger distributions. So investing in JEPI or JEPQ would still be a smart choice. But hey, I'm not the only voice here. I'm curious, what's your take on the JEPI, JEPQ and covered call ETFs? Do you think JEPI's monthly dividend will continue to dwindle or rebound from here? Share your thoughts below. And if this video was your cup of tea, do us a solid, hit the like button, give it some love. Oh, and don't forget to subscribe, because more exciting content like this is coming your way. Thanks for hanging out. I'll catch you on the flip side.